Hey everybody, welcome back to Chip Stock Investor.
Cybersecurity edition.
I almost made Nick do this video all on his own because I went outside and got bit multiple times in the face by a mosquito or multiple mosquitoes. I don't know. And I'm not feeling it.
I got one too. I'm sorry.
It's different.
Okay, the people actually just want to hear what you have to say about Palo Alto Networks, ticker symbol PANW.
Okay, let's talk about Palo Alto Networks. And don't look at my mosquito bites. Here's our cybersecurity industry bubble chart. Palo Alto Networks started in network security and then they branched out into cloud security, but they have a lot of other software that they provide services to. All of these different bubbles on the right side. As you can see, the cybersecurity industry is kind of a big deal, $215 billion in annual global spending in 2024.
And of all of the cybersecurity industry pure plays, Palo Alto Networks is the largest in terms of market cap and revenue. And so that puts them in pole position, or makes them the fastest car, if you will, if we're using our fast cars only, no moats analogy. And so Palo Alto Networks obviously has a lot of competitors that are also pure plays, but they're all battling against the software giant, especially Microsoft. As you may know, Microsoft, buried in their software revenue, is actually the world's largest cybersecurity company. It's been a while since they've updated the figure exactly how much they're making from cybersecurity sales, but at last update, almost 2 years ago, it was something like $20 billion per year in annual cybersecurity revenue. So lots of space for companies like Palo Alto, even though they're the biggest in the industry. Really, this is who they're up against as they try to chip away at Microsoft's lead. As Kasey showed you in the bubble chart here, 12% expected growth in the cybersecurity industry overall over the next 3 years or so.
Nick, you just mentioned that Palo Alto Networks is in pole position in cybersecurity, but this is just tech. There's no moats, only the fastest cars win. We recently covered Fortinet and its push into next-gen security called SASE, or Secure Access Service Edge. Fortinet has some unique advantages because it built most of its business from scratch versus Palo Alto Networks, which has built a lot of its business from acquisitions. Fortinet has a lot of products that are built using custom chips, and all of the products utilize the same operating system. That's different than Palo Alto Networks. Palo Alto utilizes 3 different operating systems to Fortinet's 1.
Yes, that's correct. Fortinet does have some unique advantages. Check that last video we just did on Fortinet for some more details on the SASE market. That said, Palo Alto Networks does have one key advantage in this fastest cars analogy. They were one of the first movers in this SASE, Secure Access Service Edge. SASE is a term that was coined by tech researcher Gartner. And so as such, we have Gartner's magic quadrant here showing that, at least by their measure, this is not an endorsement, but by their measure, Palo Alto Networks is still one of, or the leader in SASE, which is a combination of older network security, hardware-based security, and next-gen software services, all combined into one nifty package that customers can get access to. So it covers everything they need, from network to software security, in one subscription package.
Like cable.
Kind of like cable packages, but cybersecurity. That's right. Okay, so we're talking about SASE now. Let's actually provide a refresher on Palo Alto Networks' approach to this, because yes, they talk about SASE a lot, but you're also going to hear them talk a lot about this platformization strategy. Give the folks at home a refresher on this, Kasey.
They were offering some products for free to use for a while their customers moved to their full security suite platform. This basically gave customers the ability to have all of their services in one package.
And so back in the spring, there was this sell-off in Palo Alto Networks stock, and it was worry over this platformization strategy being indicative of the company losing momentum, profit margins possibly getting ready to take a big hit. We called called this out at the time as being just totally fine. This was good go-to-market business practice. And sure enough, here we are. The stock is back at all-time highs because it didn't take very long, but it looks like this platformization strategy is working. And in fact, we are in this point in the cybersecurity industry where vendor consolidation makes a lot of sense. So as companies like Palo Alto, Fortinet, CrowdStrike, which we also just covered in another video, they're all offering a lot of different services. And as they broaden their customer base outside of tech, a lot of these customers don't need the best, most expensive cybersecurity technology. They need something that just works. So maybe if you're a non-tech business, especially, you don't need to manage 12 different cybersecurity vendors. Maybe you can just knock out most of those with maybe just one or maybe two vendors instead. That can make a lot of sense.
You can see the financial results from Q3 fiscal year 2024. That's the spring of calendar year 2024. Or if you're not in the Northern Hemisphere, it was early 2024. Total revenue was nearly $2 billion. Total billings, $2.3 billion. All of this platformization discussion was distorting some of the financial metrics like billings that many investors had been using over the previous 6 years. Now, we'll come back to that thought in just a moment. Let's now move to the most current earnings report. This is Q1 of fiscal year 2025. This corresponds to the 3 months ending in October of 2024.
Yes, this explains why the stock is back to all-time highs. There really should be no surprise here. You can see that the billings metric, as management told us would, it's been deleted. And it's going to be a rub for some investors that liked seeing that shorter term metric. We get it, we understand. If you've come to rely on certain metrics in evaluating a business and now it's gone, that can cause some mental hiccups when you're trying to understand the business's future growth potential now. But you notice the switch from billings to some other more useful metrics at this particular stage of Palo Alto Networks life cycle. For example, one of them, NGS growth, or next gen services. This is on an annualized basis for the revenue of NGS. NGS is important because this section of Palo Alto Networks was largely built by acquisition, as Kasey mentioned earlier, after CEO Nikesh Arora took over back in the summer of 2018. But you can see this NGS growth has now surpassed the old networking part of the business, and it's now more than half of Palo Alto's annualized revenue. So this is what is really propelling the business forward at this point, both on a revenue growth basis and, as we'll break down for you here later on, and more importantly, profit growth. But Kasey, before we talk about profit, let's just take a brief moment here and talk about another revenue line item that's really important to understanding Palo Alto's trajectory right now, product revenue. This is different from the NGS portion of the business, right?
Yes, product revenue is part of the core older business for Palo Alto Networks, the older networking and hardware portion of the business. You're now looking at the previous quarter's metrics. Product revenue was down 5% year over year. And let's not forget that this product revenue was in a cyclical decline. Now take a look at this quarter. Product revenue is actually back to year-over-year growth. It came in at $354 million, but 4% year-over-year growth.
Okay, we are reusing this slide. You've seen this before when we've covered Fortinet, lots of chip stocks as well. Draw your attention to the cloud and enterprise end market. This includes network security hardware, that older, previously core business for Palo Alto Networks. It's been in cyclical decline now for a couple of years, much like it has been for other companies like Fortinet. This end market started to bottom out in late 2023, and it's now at the beginning of a brand new growth cycle. So that's what we saw in the metrics, product revenue returning to year-over-year growth that Kasey just showed you. 4% year-over-year growth doesn't sound like much. However, this is highly significant for Palo Alto Networks because this means that as enterprise and cloud computing hardware revenue does return to growth, it's not just the NGS, next gen services, kind of pulling and dragging that dead weight along for the ride. Having that product revenue also being back in growth mode means that for the next couple of years, let's say maybe through fiscal year 2026 for Palo Alto Networks, the whole business is now back in growth mode and firing on all cylinders and contributing to profit growth.
One more metric to take a look at in this chart, it's the remaining performance obligations, or RPOs. We said that we would circle back to billings, and this is why. Management is removing that billings metric from the guidance, but they're going to be focusing on RPO. Billings is a very short-term indicator for revenue trajectory versus RPO captures a much longer trajectory for revenue. And as you can see, it's still very positive. They expect the RPO to be up 20 to 21% year over year on a quarterly basis. And then for the full fiscal year 2025, they expect 19 to 20% year over year growth.
Quick note on this, if you're not aware, RPO, or remaining performance obligation, actually sums up the total current invoiced amount that Palo Alto Networks has sent to its customers, as well as future amounts that are under contract with a customer that have not yet been invoiced. So as the company has moved to this platformization strategy this year, where they're giving some product away for free for a time to help the customer transition from maybe another competitor, the billings are going to be highly volatile as a result of that free product giveaway. But like you saw earlier this year, when the billings growth dipped down to just 3% and a lot of investors panicked, RPO kind of zooms out and takes the longer term picture into account, because a lot of these contracts that Palo Alto Networks is signing with these customers, it's not just an annual contract anymore like it used to be in the past. Many of these are now multi-year contracts. They're much broader in scope, reflecting all of the services that Palo Alto Networks now provides. And so that's where you're getting this smoother looking growth from RPO, and why billings they've gone away. It's no longer a metric management is providing. So that doesn't have to jive with you as an investor. That's fine. We get it. We understand. But this is the reason why management has decided to just focus on RPO as a better forward-looking metric for the business overall.
Let's now zoom out for just a moment and look at the progress that Palo Alto Networks has made over the last 6 years since CEO Nikesh Arora took over. It looks pretty good. Explain this progress, Nick.
Yeah, absolutely. This is fantastic progress. Whether you're looking at free cash flow per share, which is an important metric because free cash flow per share captures the effects of dilution from employee stock-based compensation, as well as acquisitions that were paid for using Palo Alto Networks stock. You can see, despite that, free cash flow per share has more than doubled over the last 6 years. And then if you're a more traditional value investor, maybe you just use price to earnings metrics using GAAP earnings per share. A lot to like here as well. Under his tenure, GAAP earnings per share went from deeply negative to robustly positive for Palo Alto Networks. So this is fantastic news. Let's use this as a starting point, because this chart here specifically, when you're building out a long-term model for Palo Alto Networks stock, can help us figure out if we're currently at a fair value or not.
But before we get into Palo Alto Networks and all of their amazing financials and valuation metrics, we want to give a quick shout out to the sponsor of today's video, finchat.io, who helped us make this chart that you're looking at and all of the other charts that you see from us here at Chipstock Investor. They're having a Black Friday deal for all of their paid plans.
Yeah, 25% off for Black Friday. Not bad.
FinChat does not run sales like this very often. So if you want to get that 25% off any paid plan, you have to sign up by midnight on December 2nd.
As you know, we've begun using FinChat and embedding it pretty deeply in our research process here at Chipstock Investor. Why is that? Well, it's a great one-stop shop for everything from company earnings calls, transcripts, all the way to key performance indicators, or KPIs, if you want a better visual representation of how and why a business makes money.
If you've ever thought about signing up for FinChat, now is a great time to do it. 25% off any paid plan before December 2nd at midnight using our link finchat.io/CSI, link in the description below.
Okay, now before we get back to some more charts using FinChat, I hope we don't lose anybody here, but if you want to build an accurate representation of whether a stock is a good value or not, we have to do some digging into some of the deeper financial metrics like this, not just revenue growth. Let's start by taking a look at the cash flows from operating activities.
Don't skip this. Don't worry. Nick has broken this down for us. Keep watching. Let's start with the yellow and the red highlights. GAAP net income is now in the black. However, in the next quarter, which will be Q2 fiscal year 2025, the trailing 12-month GAAP net income metric is going to lose a deferred tax income benefit. This is going to make Palo Alto stock look more expensive after the next report.
Yeah, and we're going to put more expensive in air quotes here for just a moment. The reason why that is notice the second red highlight here on this table. The deferred income tax benefit they realized in Q2 of last year was just under $1.7 billion. That's going to go away. And so we can roughly expect GAAP net income to be, let's say, $350 to $400 million, in line with where it was and where it has been the last couple of quarters, not over 1.75 billion like it was in Q2 last year.
Next item of business, let's talk about stock-based compensation. This is something that comes up with a lot of cybersecurity companies, especially. We've highlighted that metric in orange. It's still a bit high, but it's at a much more manageable level going into this most recent quarter as the total percentage of the revenue and Palo Alto market cap, of course, has increased. And so that stock-based compensation is a smaller percentage.
Yeah, this is actually quite positive development. You've seen overall maybe a very slight increase in stock-based comp in the last quarter, mostly in line though with where it was a year or two ago, which means as a percentage of the company's market cap, which is much, much higher than it was 2 years ago, this number has actually gotten more reasonable. So this concern, in our opinion and in our viewpoint on the valuation of Palo Alto Networks, this issue is largely taken care of now.
Okay, Nick, time to tell me about the blue and green highlights.
Okay, so this is where it's going to really help with calculating the fair value of Palo Alto Networks right now. Operating cash flow, you'll notice in green at the very bottom, is down a bit year over year in this most recent quarter. This again has a lot to do with accounting effects related to platformization that Palo Alto Networks has been doing with its customers. Accounts receivable, there up above in blue, is quite high, especially in Q1 every year. It's always elevated. This has a lot to do with billings and customer contracts at the beginning of the fiscal year when Palo Alto sends out invoices to customers. But even so, you can see that it is elevated in Q1 this year, a big sizable jump versus where it was in Q1 fiscal 2024. And that's why operating cash flow is down on a year-over-year basis. This is going to feed into our free cash flow metric that we're going to discuss here momentarily. Okay, hope you're still taking notes and that you're still with us here. We're going to take a look at the rest of the cash flow statement.
Yeah, you can see CapEx was a bit higher in the most recent quarters. That's pretty natural given that the business is growing and more than likely it's spending some of that cash on NVIDIA GPUs.
Naturally.
As a side point. But also look at the $500 million paid for business acquisitions. That's in blue. That cash spent was for IBM QRadar, or SIEM, Security Information and Event Management. That acquisition was completed in Q1 of fiscal year 2025, and this is going to distort the short-term cash that Palo Alto has been able to invest.
Okay, and then last, certainly not least, in green again, we have stock repurchases. You can see that those have been paused for the last 2 quarters on the second line. However, instead of stock repurchases, Palo Alto has been making repayments of convertible senior notes. That's debt that would have otherwise converted into brand new Palo Alto Networks stock and diluted existing shareholders. So instead of making stock repurchases, they've been paying off some of that debt the last few quarters. Well over $1 billion worth of this debt has now been paid off in the last year. And so this is effectively, it does the same thing as a stock repurchase. It otherwise eliminates what would have become extra stock floating around out there that dilutes your share of Palo Alto's profits.
So, all in all, there has been some short term accounting effects that have reduced Palo Alto Networks' cash conversion as a business. But you can see all the way at the bottom, the last screen highlight, this company is still very much generating lots of cash, about $746 million worth alone in the last quarter. And all of this feeds into the balance sheet, which looks pretty good.
Yeah, it does. It keeps looking better quarter after quarter.
Here's another visualization of that. This is definitely a tech giant in the making. The convertible debt is nearly paid off, just under $646 million. And that means that Palo Alto has some pretty serious firepower to invest in future growth or to be repurchasing stock once again.
Absolutely. Lots of firepower indeed for a company of its size. Almost 3.4 billion in cash and short-term investments, over 4.1 billion in longer-term investments. Yeah, this is what you would call a war chest when you're dealing with a cybersecurity industry undergoing consolidation or platformization, as Palo Alto has been calling it. This is the kind of balance sheet that you want in this type of business and industry environment.
All of that explaining is to set up our discussion about the valuation of Palo Alto Networks. At the top of this chart, you can see price to earnings nearly 50 times, price to free cash flow nearly 41 times, and on a trailing 12-month basis, both of these are high. It makes sense because the business is growing and increasing margins in a secular growth trend industry. But is the valuation too high? What do you think, Nick?
Okay, so this is where we need to look at the 1 year forward price to earnings metric. Let's start there. And we're going to use the PEG ratio because this has begun to come up much more frequently now that I think most investors have finally now arrived at this consensus that yes, we are in a bull market. At least for the last year or two, we've been in a bull market and we have a long runway of business growth ahead of us. So PEG ratio, over 4 times the 1 year expected growth rate. That is egregiously high. However, this metric is almost useless because remember, in the next 12-month metric, we're going to lose that Q2 2024 tax income benefit that was realized last year. So of course, the PEG ratio looks totally out of whack because on a forward price to earnings basis, Palo Alto Networks is probably not going to grow its GAAP earnings per share because of that income tax benefit going away.
Okay, so that's the PEG ratio. What about on a price to free cash flow basis?
Yeah, this is where getting a fuller picture of all the profit metrics makes more sense because we do need to use price to free cash flow, at least at this particular point in time, to get a handle on where Palo Alto is. So you can see that line highlighted in green, 34x price to free cash flow on a 1 year forward basis, definitely still a premium price. But as Kasey mentioned, deservedly so. So if the company keeps delivering on its profit margin growth, that's where you get this estimated highlighted in pink on the right-hand side of the screen for a long-term growth rate of 21%. Let's call this good, not just for earnings per share, but I think in our expectation also free cash flow growth over the next, let's say 5 years. Our estimate is we could see upwards of 20% free cash flow growth for Palo Alto Networks.
So, is all of this reasonable? Let's take a look at one possible future scenario that gets us to a fair value based on the stock price today. Now, remember, this is a reverse DCF. It's not our estimate. Rather, it's Wall Street's implied estimate based on the current stock price, which is the in the moment consensus for a business. What you're looking at here is the reverse DCF up from about 6 months ago when the market was feeling pretty glum about Palo Alto Networks stock.
Now, We've updated it 6 months, 7 months later here in November. Kasey, walk us through this because this looks just about the same.
You're right, it does. But the business is bigger in terms of market cap, revenue, profit, everything else. You can see that even though the stock price is significantly higher, around $383 per share, the long-term assumptions that get us to this fair value have only increased slightly. And in fact, in this particular instance that we ran, we actually decreased the profit growth expectations for the next 3 years, which is basically the most important input that you would put in a DCF equation.
Yeah, absolutely. The first years of profit for a DCF model are hands down the biggest drivers of where the stock should sit at this current point in time. Of course, over the long term, if you're using a terminal growth rate, this thing can be very, very sensitive, especially as you increase that terminal growth rate. If you bump it up just a 0.5% or a full percent, let's say from 6.5 to 7, all the way up to maybe 8%, you're probably going to get a fair value that's double what it is from what we have listed here at 380 to 400. So all of that's very important in thinking about fair value estimate for the business. But this is one scenario that gets us to the fair value on the stock today. But the point that we're trying to get at here is, yes, the stock price is up 20, 30% from 6 months ago. However, the expectations for the long term remain about the same for this business. So, Kasey, what does that mean in our assessment of Palo Alto Networks?
Well, I think ultimately it means that we actually feel like Palo Alto Networks is closer to fair valued versus egregiously overpriced. But given the nature of the industry and Wall Street's short-sightedness, volatility to the downside is inevitable.
Agreed. Again, so what we're not saying here is that Palo Alto Networks is a cheap stock. Absolutely not. It has a premium price tag on it. That's 100% a for sure thing. So if this doesn't fit your criteria for investing, that's totally fine. You can safely move on. It's okay. It doesn't have to be in your bag. There are other cybersecurity companies out there. However, if they have a cheap price tag, question you need to be asking yourself is, why is it cheap, and is it cheap enough? Because companies like Palo Alto Networks, Fortinet, CrowdStrike, Zscaler, the top 3 or 4 cybersecurity pure plays are gobbling up this industry and are doing serious battle with Microsoft.
It's good to remember that if you decide to add Palo Alto Networks to your portfolio, this is going to take some time to see the actual progress, maybe even up to 5 years to measure the progress in your portfolio. That's not necessarily a bad thing. In fact, we're very happy to continue holding Palo Alto in our portfolio. It's part of our core basket of cybersecurity stocks.
Yeah, we talk about that cybersecurity basket of stocks all the time over on Semi Insider. It includes Palo Alto Networks, Fortinet, and CrowdStrike, which earned its way into a core position in that basket when we invested in it originally shortly after the IPO some number of years ago. And then some smaller up-and-coming players, including Cloudflare. Check out Semi Insider. We talk all about cybersecurity companies all the time over with the members. Semi Insider, just $5 a month until the end of this year.
Thanks for watching, everybody. Make sure you hit the sub channel and the like button. Share with your friends. We'll see you again soon at Chip Stock Investor.